A lot of you have been asking me about the difference between RRSP and TFSA, Registered Retirement Savings Plan versus the tax-free savings account. This video is going to show you which is better for you and what you need to consider before you start off with either one. We will first go over the basic differences and similarities between the two types of accounts, so you have a better understanding of both the accounts, and then go through the three scenarios where one account might be better than the other. In the first scenario, we'll talk about someone who's earning a high income now and will have a middle class retirement. In the second scenario, we'll cover someone who's earning a middle class income now and will have a middle class retirement. And the last scenario will cover someone who falls in a low tax bracket now and will remain in a low tax bracket during retirement. And then we'll conclude by talking about some key points to consider. Let's start off with some basic differences and similarities between the two accounts. Any contributions you make to your RRSP account are tax deductible, which can potentially create a high tax refund. Any investment gains within your RRSP account, like capital gains, interest income, or dividends, will not be taxed until you withdraw that money. And any money you withdraw from your RRSP account will be added to your income, and you will be taxed accordingly. CRA sets a contribution limit every year on how much you can contribute to your RRSP accounts. It's the lower of 18% of your last year's income, or the maximum annual limit, and for 2016 it's $25,370. Any unused room you had in the past is always carried forward. And RRSP has some neat couple of features. Especially for first-time home buyers, there's a Home Buyers Plan, HBP, which lets you withdraw up to $25,000 from your RRSP account tax-free. And there's another feature called Lifelong Learning Plan, the LLP, and it lets you withdraw up to $20,000 towards your education. And last key point to remember is that there is no reusable room after a withdrawal is made. So if you initially contributed $10,000 and down the line you withdraw that money, then you lose that contribution room. Now let's compare that to the tax-free savings account. Unlike RRSP, any contributions you make to your TFSA do not lower your taxable income, which means contributions into TFSA are not tax deductible. Basically, you will have a higher tax refund under RRSP than TFSA. Also, similar to RRSP, no capital gains under TFSA will ever be taxed. And unlike RRSP, you will never be taxed on any withdrawals you make. All withdrawals are tax-free. CRA sets a much lower limit on TFSA than RRSP. So for 2016 and 2017 year, the maximum you can contribute to your TFSA accounts are $5,500 each year. Also similar to RRSP, any unused room is carried forward. But unlike RRSP, any room from withdrawals can be reused in the following year, which basically means if you took out $5,000 in 2016, you can contribute that amount back into your TFSA account in 2017. Now that you have a better understanding of the two accounts, let's take a look at our first scenario, in which a person is making a high income now and will have a middle class income retirement. If you find yourself in this scenario, then this is the ideal scenario for RRSP account. You should contribute to your RRSP account first before you get into your TFSA. So let's walk you through a simple example. Assuming you fall under a 40% tax bracket and you contribute $10,000 to your RRSP account, you should expect a $4,000 tax refund. And in retirement, when you take out the $10,000, And assuming you fall under a 20% tax bracket, then you will only have to pay $2,000 tax on that withdrawal. Again, remember guys, the RRSP limit is much higher than the TFSA, so use that limit first. And one key point to remember is that your old age security benefits, the OAS benefits, will be reduced. Old age security is dependent on how much income you make, and the RRSP withdrawals will add to your taxable income, so your old age security will be reduced accordingly. Now in this scenario, you should contribute to your tax-free savings account after you have contributed to your RRSP. And for high income earners, you should also use your tax-free savings account. Even though there is no tax deduction on your tax-free savings account, this account will still help you save. And remember, all capital gains in this account will always be tax-free. Even if you have no money left after contributing to your RRSP account, the tax refund that you will generate, you can use that tax refund and contribute to your RRSP account. Remember, there's a lower limit on TFSA than RRSP, and you can take money out at any time tax-free. And last key point to remember is that unlike RRSP, there will be no impact on your old age security benefits if you withdraw any amount from your tax-free savings account, because it's never included in your income. And now let's talk about second scenario in which most Canadians will fall under, where someone is making a middle class income now and will have a middle class income retirement. In this scenario, you can use a mixture of RRSP and TFSA. Again, remember, the RRSP contribution limit is still higher than TFSA. So let's assume if you fall under a 30% tax bracket and you contribute $10,000 to your RRSP account, you should expect a $3,000 tax refund. Now you can use this $3,000 tax refund to contribute to your TFSA account. Here is a perfect example of using a hybrid of RRSP and TFSA accounts. Again, remember, the old age security benefits in your retirement will be reduced according to your income from your RRSP withdrawal, but your old age security will not be impacted at all by your TFSA withdrawals. So try to use a hybrid of the two accounts if you fall under this scenario. Now think about the future and where you're at now. If you find yourself in middle class income now and you expect to get into a high tax bracket in the future, then you may want to consider holding off onto your RRSP contributions and instead focus on TFSA. And when you get into a high tax bracket, then start contributing to your RRSP account. In this scenario, you can be really creative between the two accounts, but again, you have to plan accordingly. Now, let's talk about our third scenario, in which someone is making a low income now and will have a low income retirement. If you find yourself in this scenario, then it is not recommended to use your RRSP, and most millennials are in the beginning of their career right now. So if you find yourself in this scenario, save that contribution room in your RRSP and catch up once you're in a high tax bracket. Again, remember, RRSP withdrawals will increase income in retirement, and if you have a low income retirement, you don't want that. Otherwise, it will put you in a high tax bracket. And for those who expect a low income retirement, the government of Canada offers GIS, Guaranteed Income Supplement, for low income retirees. But if you are incurring income because of RRSP withdrawals, GIS could be reduced by as much as 50 cents for every dollar in income. So that's almost a 50% tax levy on any additional income. So you may want to stay clear of RRSP. Now, in a low income scenario, it is preferred to use TFSA over RRSP. Use your tax-free savings account to save for the future and grow by investing. Again, remember, any capital gains are tax-free, and any withdrawals you will make on TFSA will always be tax-free. And you can make these withdrawals anytime you want. And unlike RRSP, there will be no impact on GIS or Guaranteed Income Supplements from your withdrawals from your TFSA account, because they do not contribute to your income. Again, just to summarize it really quickly, if you're in the beginning of your career and you find yourself in a low income bracket, you may want to stay clear of RRSP and save that contribution room and catch up on it when you're in a high tax bracket. That way, you will get a higher tax refund and you will benefit from the real purpose of using RRSP, which is to contribute in your high tax bracket income and withdraw money from your RRSP during your low tax bracket years. Now, here are some key points for you to remember. Make a plan. I don't expect you to make a plan for the next 30 years, but try to make a plan for the next 5 years. Remember, the best use of RRSP is during your high income years. Contribute during your high income tax bracket years and withdraw from it during retirement when you're in your low tax bracket years. If your company offers a pension matching plan, then for sure use your RRSP account. Be creative. Contribute to your RRSP and use the tax refund you generate from that to contribute to your tax-free savings account. High earners should max out on both accounts. You should first contribute to your RRSP accounts and then contribute to your TFSA account. Millennials who are at the beginning of their career prefer to use TFSA at the beginning and then catch up on your RRSP contributions later on in your high tax bracket years. Think about when you need to withdraw money. Remember, any money you withdraw from your tax-free savings account is tax-free and you can take it out anytime you like. But if you take it out from your RRSP account, it will be added to your income and it could potentially put you in a higher tax bracket. Also remember, RRSP has some couple of features that no other plan has. Home buyers plan for first-time home buyers and a lifelong learning plan for people who are going back to university or college to upgrade their education. At the end of the day, the point of the two accounts is to save, to help you save money for your future, for your retirement. So if you're confused, just go with either one. Make a best guess estimate, save for your future. That's the key. I hope you guys enjoyed this video, and if you have any questions or concerns, please feel free to post them in the comment section below.